Palantir creates software platforms that analyze large complex data sets that in turn help organizations make data-driven decisions in areas like defense, healthcare, finance, and others. Now, when we take a look at this company, you could have bought this around 2 years ago at the $7 mark, and right now you would be up more than 10 times on your position. It feels like every day this company continues to climb higher. So we're going to understand what is going on with this company. Is it still looking like one to consider for the future? They are getting a lot of contracts, or in fact, is this a bubble and we should consider going nowhere near? Now, the first thing we do want to point out, it is trading right now towards its 52-week highs at around $81. We do get a triple hold rating from Seeking Alpha, Wall Street, and Quant, although we do note the 3.49 isn't far off the 3.5 to flip them into a buy. Therefore, we would say they are on the fence, and their valuation that only continues to get higher day by day is sitting at 202. So we're going to discuss that in today's episode as well. But the first thing we do want to highlight is their earnings that they did report just last month, and it was fairly strong. When we do take a look at the numbers, we can see they had 10 cents per share when the market anticipated 9. Their revenue was also impressive, 726, the market wanting 701, and we can see that is growth of around 30% year over year. Now, you may think that with the way this company is valued, you would be expecting larger growth, but we can also see not only the numbers were very good, but in fact, in terms of the guidance, they actually had it higher than what the market was anticipating of 741. They came out 767 to 771. Just a few weeks after that, the share price continued to climb as they did announce they were moving to the Nasdaq, a move that the investors and the market liked a lot. And one thing we have noticed over the last few months, one of the reasons that we can pinpoint as to why this company continues to climb higher, because as you can see, the black line, which is in the background, it is going up and up, especially over the last year or two, which indicates that institutions could possibly be one of the main drivers for why this company continues to increase higher, which has put the valuation into crazy territory. When we also take a look, one thing that is great with this company, whilst the valuation may be very high, we do see every few days or every few weeks where new contracts are being delivered to this company. Now, this isn't necessarily a new contract. What they have done is expand the current contract, that is the US Special Operations, and this is valued at around $37 billion. And when we do come to look at their earnings right now, the contracts that this company are acquiring only seem to be getting larger as well as more frequent by the day. One other thing to mention, although maybe a little bit outdated, but in 2024 we did see Palantir being admitted into the S&P 500. One thing that is great with a company, any company in fact, is to see their bottom line increase over the longer term. One reason why they have highlighted it in their investor presentation is because when we do run through their financial statements, you'll see this isn't a company that has been reporting a net profit for a very long time. So they are just showing now the last few quarters where they have turned GAAP profitable. In terms of looking at the revenue itself, we already mentioned around 30% when you do compare it to the same quarter last year. However, if you want to look at it on a quarter by quarter basis, it is lower, around 7%, and they attribute a lot of this to the acceleration, in particular to the US segment of the business. In terms of looking at other metrics, one thing we really like on this channel, not companies like Palantir has done, increasing their top lines, but also increasing their margins, something that Palantir have also done. In fact, their operating margin was sitting at 29% in Q3, now sitting at 38%, which is phenomenal to see because they're increasing their revenue whilst also increasing their margins. That is something that is very difficult and not something we do see by a lot of companies on this channel, which is why we do call that one of the criteria of identifying a high quality company. As we just mentioned, they are increasing the number of deals, and not just the number itself, but look at the value as well. They have 36 which they closed in the more recent quarter that are worth at least $5 million, and we can see 16 which are worth at least $10 million. And when we have analyzed this every single quarter, they only seem to increase, which is why you could argue we are seeing a lot of this being put into the price right now. Investors do believe this large growth will only continue for Palantir, and that is why at the end of the episode we will get to our valuation to understand what level of growth is already baked into the company. As we will come to show you their balance sheet shortly, what we have noticed, it is looking very strong. In fact, they have 4.6 billion sitting in their cash. And one thing we love with this company, they are sitting on very little, or in fact, as they say, no debt. Again, we will come to show you that. That is another very clear indication that this is a high quality company. And over the last quarter, not only their cash from operations have been increasing, but we also notice their free cash flows also at a very rapid rate. And in turn, when we look at both their next quarter, where growth is expected to continue to propel them to near the 1 billion mark for the quarter, something we do anticipate we will see in FY25, we also notice the adjusted free cash flow, what they're expecting for the full year, now looks to be sitting around 1 billion. That is very, very important, because when we are going to come to our own free cash flow valuation, this is one of the metrics we will be focusing on. Other things that we do like to look on this channel is insider as well as institutional movement, and we can see insider ownership sitting at 13%, although we do see around 2.4 billion worth of sales by these insiders over the last 12 months. Just in Q4, the most recent quarter, we see around 1.35 billion worth of sales. And when we look to see who these insiders are, we can in fact see quite a lot of notable insiders. The most recent, just a few days ago, the 3rd of December, where in fact around $368 million worth of shares were sold. Now remember, the information is here for transparency. We just want to let you know, typically insider selling isn't something we focus on this channel, as it isn't a bearish signal. They sell for many reasons, personal and financial, but maybe something you do want to include in your own investment thesis. In terms of institutional ownership, sitting at 46%, around 1 billion worth of sales over the last year. But as we have pointed out, institutions continue to add a lot of shares, more than 5 times over the same time frame. And just look at Q3, we can see a significant amount more buying. And when the Q4 data is released, we do anticipate this trend will continue to be shown. If we just go back to the company, as we said, pretty much trading at its all-time highs, just over the last 12 months, this company is up 346%. That means that is around a 4.5x if you had bought 1 year ago today. Absolutely incredible. Can it continue? Is it actually worth the price it is trading at now? And what value is baked in? Again, questions we are going to answer. Then when we look at the earnings as well as the expectations, over the next 4 quarters, Palantir are expecting double-digit growth to the EPS for every single one. And what we do like is that over the last 4 quarters, they have either been in line with expectations or a marginal beat. That is a 100% historical forecasting accuracy, and in turn giving us faith that over the next full accounts, they will hit the 47 cents they anticipate, which in turn will lower the forward P to 161.45. Now that is still very, very high. As we said, these valuations are getting a little bit out of hand, but that doesn't necessarily mean it is overvalued or we shouldn't consider, or even in fact just holding it if it is one that we own. In terms of some of the metrics that we like to pinpoint on this channel, first one is the free cash flow growth. As always, earnings data is shown if you do want to take a look, not one we do draw your attention to, as we do believe it is susceptible to manipulation by management through accounting. We do like the fact that it has gone from negative to positive and started to increase. In fact, on the trailing 12 month, there is a nice jump from 2023. And as we saw, they anticipate 1 billion for the full year of 2024 in terms of the total amount. Looking at the sales growth top line, we do get double digit every single year, 17 in 2023, 25 on a trailing 12 month, but you may want to question whether or not this is actually deserving of the valuation of the premium, given that we have seen a lot of growth companies with in fact as good if not similar growth rates with a significantly lower forward valuation, and that isn't the only valuation metric, as we will come to show you, that does give off severe undervaluation signals. From a numerical perspective, you can see that very strong growth. Now, one thing we would say, we'd like to highlight here, companies that return excess cash through those share buybacks. Now look, they have been diluting your position as a shareholder over the last few years, but if you're someone who has bought in the more recent period, you probably wouldn't care about share dilution as long as they continue to outperform and massively outperform as they have done the S&P. ROIC, one of our favourite metrics on this channel, 10% or more, give us faith management are able to effectively allocate their capital. Now, they've been negative for quite some time. As we will show you, this is in correlation to the fact they have been reporting a net loss, 3% in 2023, 8% on a trailing 12 month. We do anticipate this will continue to move up higher and higher over the longer term, given how strong those numbers have been in the more recent period. Operating margin, we want to see not only growth year on year showing efficiencies, but at least above the minimum 12%. We get that on the trailing 12 month, again something we do anticipate to continue moving forwards. And the free cash flow margin looking very, very strong over the last few years, 40% on a trailing 12 month. That is very strong. And again, Palantir does have a lot of good going for it, especially in the more recent quarters. Net debt to EBITDA, again, another one of our favourite metrics. EBITDA relating to the earnings before interest, tax, depreciation, amortization. And this metric correlates to balance sheet strength, showing us the number of years it would take the company to pay off all of their debt, net of cash on hand. This signals the last 4 years, trailing 12 months, as well as over the next 12 months, it won't take Palantir one day to pay off all of their debt, net of cash on hand, showing us they have a phenomenal balance sheet, as we did already allude to earlier in the episode. Now, we also want to let you know we have just released our latest free weekly article where we've highlighted one stock we are buying heavily this month. Now, as we said, we release it every Monday morning completely free, and we highlight severely undervalued stocks for your attention, as well as what's gone on in the market over the last few days. So click below, you can sign up and start reading straight away, where you'll also be able to gain access to 28 undervalued dividend stocks for the month of December. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 29 undervalued stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. Now, other pieces of our analysis include looking at the income statement. Now, we've already talked about their revenue growth over the longer term. It has looked very good. And as we can see, based on the trailing 12-month December 2024 annual accounts, will also show some very strong growth in the double digits. But what we really wanted to flag here was their bottom line. As we said, this company has only recently started to turn a net profit, and great thing to see, whilst 2023 is at 210 million, based on the trailing 12 month, we do expect this to continue being a net profit and moving in the right direction. So that is good news for shareholders. Then we want to flag the balance sheet. Although we have said a few times today, it does look very, very strong. We always do a cash versus total debt comparison. As we can see, in line with their revenue, cash is going up 1.1 billion in 2018, 4.6 in the latest quarter. And the reason why we do compare it to their total debt, because just one number in this balance sheet won't give anything away, so we compare it numerically and directionally to their total debt, which, as we can see, has been decreasing over the last few years. Was sitting around 0 in 2018, right now around 255 million. That is significantly lower than their total debt. As we've already said today, won't take Palantir even one day to pay off all of their debt, net of cash on hand. Then we just want to run through the cash flow. Main thing we want to show you is that their cash from operations in the more recent term has turned positive, looking very good. 712 million in 2023. Based on a trailing 12 month, about to hit that 1 billion, looking very positive. Now we want to move into some gradings. The first one is an F, no surprises at all for the valuation. As we can see, their P on a non-GAAP basis above the 200 mark, sector median at 26.5. So right now, if you are hitting the buy button on Palantir, you are paying a 660% premium. That is something that is reiterated no matter what valuation metric you use. This company is trading significantly higher. Is it worth a premium? That is the first question. Well, based on the growth, answer looks like yes. It gets an A because their revenue year on year, 25% better than the sector at 4. Revenue moving forwards, 22 better than the sector at 5.6. And we also notice one metric we like to highlight, their earnings per share over the next 3 to 5 years, anticipated 27.5 with the sector median at 15.6. The other reason they deserve a premium, well, profitability also looking better at an A. Gross margin, 81, sector median at 50.3. Bottom line margin, 18, a lot better than the sector at 3.8. And we can also see cash from operations just under 1 billion, whilst the sector median, 97 million. Now, just a quick recap for this part of the analysis: triple hold across Seeking Alpha, Wall Street and Quant, F on valuation, A on growth with an A on profitability. Now, two more things before we do jump into the valuation model itself, comparing their performance against others in the software space of similar size. Now, over the last year, Palantir is up 346%. You may think that is the best performing, but we can see others that have performed significantly better. And over the last 3 years, we can in fact note they are still up very strongly, around 309. Now, don't get me wrong, that is an absolutely phenomenal performance, but do bear in mind their past performance is not an indicator of the future. They could perform a lot worse, but at the same time, they could perform significantly better. The other thing that we want to highlight, although the answer should be very clear, is their performance against the S&P. Massive outperformance over the last year, massive outperformance over the last 3. But remember, we do like to include this just to get you thinking about whether or not you have faith in individual stocks that they will outperform the S&P over the longer period. Now let's jump into our valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value today comes from the DCF model. Now we'll show you how we got there. We have the free cash flow just over the last few years. We have the growth negative, a little bit skewed given the fact that it has gone from positive to negative for a few years. Now we've gone for 35% moving forwards. With the discount rate at 8%, we get the present value of future free cash flows and terminal value. Remember, starting off with their expected for the next full year. Add with the cash, subtract the total debt, get to the equity value, divide by the shares outstanding, and as we can see, $59 indicating downside of 27%. Now what that means is if you believe moving forwards over the longer term, Palantir will be able to increase their free cash flows at 35%, there is actually downside from the current price. Remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Palantir or any others. Full transparency will show you at 30%, it would in fact be $45, downside of $44, and at 40%, as we can see, $77, downside of 4%, not too far off. So you could argue right now in the price for Palantir, around 40% growth over the longer term has been baked in. Now we're going to use the 35%, and as you can see, we always like to use a margin of safety on this channel where we do start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Well, first thing to say, it would be a buy with a 10% MOS at $53, but what we're trying to say today in the episode is that we believe this company around the $60 mark is the fair price, so we can see it is trading at quite a solid premium. Now, it does look like institutions are buying a lot of shares, which has been driving up the price just over the last few months. They've been included in the S&P, they've been included in the NASDAQ, so this price could continue, but also bear in mind, given how expensive it looks from a valuation, there could also be a pullback. Who knows? Well, the answer is no one. We'll just show you though, MOS at 10%, a buy at 53, at 15 around 50, at 20 around 47, at the 25% mark, $44. We also notice that Wall Street have upgraded their price target to $75, and that means from the current price, they see 7% downside over the next year. We'll leave you with this final thought for those that believe this could be a $1 trillion company very soon. Around the current price, their market cap is $180 billion, so they would hit $450 without a stock split if they were to achieve the $1 trillion mark. As always, I would like to hear your thoughts in the comments below. What do you believe is happening with this company? Is it undervalued, overvalued, maybe just a hold for now? And if you did enjoy the episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below, grab those spreadsheets, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.